You sign the papers. Your local bank funds the house. You assume it owns your mortgage. It may not. Within weeks, the lender can sell your loan into a $13.8 trillion mortgage system. The company you pay every month may not own the debt either. It may only service the account. A trust may hold the pooled loans. Fannie Mae or Freddie Mac may guarantee them. Investors may own claims on the cash flows. This is not a technicality. During financial distress, your options can depend on rules set by the loan's owner, investor, or guarantor, not merely the logo on your statement. The missing link is the split between the servicer, the guarantor, the trust, and the investor. Follow one mortgage through that chain, and the idea of a single owner disappears. Here's where your mortgage goes, and who controls each layer. At closing, the most important object is not the house key. It is the mortgage note, your legal promise to repay. A mortgage or deed of trust secures that debt against the property. The lender that funded the loan can keep the note, but often it does not. It can sell the loan into the secondary mortgage market, turning a long stream of future payments back into cash that can fund another mortgage. A lender has limited balance sheet capacity. If it keeps every 30-year mortgage, its money stays tied up for decades. Selling eligible loans changes that. Fannie Mae says its whole loan conduit bought from roughly 1,200 single-family lenders in 2025. The lender receives cash or another marketable asset and can originate again. The borrower keeps the same contractual debt. The financing chain behind it has changed. An eligible conventional loan can reach Fannie Mae in two basic ways. A lender can sell the whole loan for cash, or it can deliver mortgages and receive Fannie Mae mortgage-backed securities in exchange. Freddie Mac operates a similar secondary market model. Either route separates origination from long-term funding. The bank that approved your application may therefore disappear from the economic ownership chain soon after closing. The payment relationship is a separate asset. Fannie Mae allows lenders to retain, release, or sell the servicing rights attached to loans they deliver. That means one company can fund the mortgage, another can own the debt, and a third can collect your monthly payment. Servicing includes statements, escrow administration, payment processing, customer questions, and delinquency work. The logo on your statement tells you who services the loan, not necessarily who owns it. Now the note can change form again. Fannie Mae or Freddie Mac can place mortgages into a pool and issue a mortgage-backed security, or MBS. Fannie Mae says its securities represent beneficial interest in mortgage loans held in trust. Freddie Mac describes its securities similarly. Investors receive ownership interests in pools and rights to cash flows. So an investor usually buys exposure to a pool, not the right to personally manage one homeowner's account. Fannie Mae and Freddie Mac do not make ordinary home loans directly to borrowers. They buy qualifying mortgages from lenders, package many into securities, and guarantee scheduled principal and interest to investors under their programs. That guarantee changes who bears credit risk. Investors still face market risks, including interest rate and prepayment risk, but the enterprise stands between mortgage credit performance and the promised security cash flow. Once the security exists, investors around the world can buy it in capital markets. Their money travels backward through the chain. Investors fund the securities. The securities finance mortgage purchases. Those purchases return cash to lenders. Lenders make new loans. Your monthly payment then travels forward through servicing and the security structure. The same mortgage connects a household balance sheet to global fixed income markets. For normal payments, the servicer has the most visible control. It sends statements, collects principal and interest, manages escrow when required, and answers account questions. But the servicer is often an agent working under contracts and investor rules. It does not simply rewrite the loan because it wants to. The distinction matters most when something goes wrong, because operational control and economic ownership can sit in different companies. If a borrower falls behind, the owner or assignee can shape which loss mitigation programs exist. Federal servicing rules require servicers to evaluate borrowers using applicable owner or investor requirements. The The Consumer Financial Protection Bureau also imposes procedures and timelines around delinquency and foreclosure. In general, a servicer cannot make the first foreclosure notice or filing until a borrower is more than 120 days delinquent. Control is divided, but it is not unregulated. This corrects a common picture of securitization. A pension fund or bond fund holding an agency mortgage-backed security does not normally call the servicer and order a foreclosure on one house. The investor owns a security interest in a pool. The servicer handles the account. The owner, guarantor, governing documents, and applicable law define the decision framework. Financial ownership has been fragmented into layers rather than handed to one all-powerful actor. That layered system becomes visible when a servicing transfer arrives in the mail. Federal rules generally require the old servicer to notify you at least 15 days before the transfer, and the new servicer within 15 days afterward. There is also a 60-day protection period for certain payments mistakenly sent to the old servicer. The debt terms do not change merely because the servicing rights moved. The payment destination does. Ownership can move without servicing moving. Under federal disclosure rules, a new owner of an existing mortgage generally must provide a transfer notice within 30 days. The Consumer Financial Protection Bureau also says borrowers can ask their servicer who owns the loan. This matters because the company receiving your payment may be only the administrator. A mortgage statement can show the front door while the economic owner sits deeper inside the structure. The architecture was designed to solve a funding problem. Fannie Mae was established in 1938 to support mortgage liquidity. Freddie Mac was chartered by Congress in 1970. Instead of forcing local lenders to finance decades of mortgages entirely from their own balance sheets, a national secondary market connected home loans to capital market investors. Standardization made mortgages easier to buy, pool, price, and resell across the country. The financial crisis exposed the danger of concentrating so much housing finance around two enterprises. Fannie Mae and Freddie Mac entered federal conservatorship in September 2008. They remain there. The Federal Housing Finance Agency says that, as conservator, it has ultimate authority over enterprise operations. The Treasury also maintains financial support agreements with both companies, yet their mortgage-backed securities are not formally debts of the United States government. In 2025, Fannie Mae and Freddie Mac purchased $725 billion of single-family mortgages. They also purchased $150 billion of multifamily mortgages. That flow keeps lenders supplied with funding even when individual banks want to reduce balance sheet exposure. It also means mortgage credit depends heavily on common eligibility rules, securitization infrastructure, servicing standards, and investor demand. Efficiency and concentration arrive together. Every layer has an economic role. Originators earn lending revenue and may realize gains or losses when loans are sold. Servicers receive compensation for administering accounts and may retain certain permitted fees. Fannie Mae and Freddie Mac charge guarantee fees for standing behind eligible mortgage-backed securities. In 2024, the average single-family guarantee fee across both enterprises was 65 basis points, or 0.65% annually on the loan amount. Investors receive the remaining security cash flow. Wall Street does not only care whether homeowners pay, it also cares when they pay. A 30-year mortgage can disappear early if the borrower sells the home or refinances. Then principal returns to the security investor sooner than expected. That is prepayment risk. When falling rates trigger refinancing, investors can lose a high-yielding asset precisely when reinvesting becomes less attractive. Mortgage pricing, therefore, reflects capital market behavior as well as household credit risk. Follow one mortgage note. A lender originates it. Fannie Mae or Freddie Mac may acquire or guarantee it. A trust can hold the mortgage pool supporting a security. A servicer collects the borrower's payment. Investors own interests in the mortgage-backed security. If the servicer changes, the security can stay the same. If investors trade the security, the servicer can stay the same. The borrower experiences one bill, while the financial system sees several separate contracts. Some banks keep mortgages in portfolio. Other loans may enter private securitizations. Government-insured mortgages often use another channel. Ginnie Mae guarantees securities backed mainly by Federal Housing Administration, Veterans Affairs, and other federally supported loans, but it does not buy the underlying mortgages itself. This matters because Wall Street owns your mortgage is too crude. Different loan types create different chains of ownership, guarantees, servicing, and public support. When payments are current, these distinctions can feel academic. During hardship, they become practical. The servicer is the borrower's operating contact. The investor or guarantor may determine which workout programs are available. Federal rules constrain timing and procedure. A servicing transfer can move the human interface without moving the underlying owner. The person facing job loss or another financial shock therefore interacts with a company that may be executing rules written somewhere else in the chain. A borrower does not have to guess. The monthly statement identifies the servicer. Fannie Mae and Freddie Mac both provide loan lookup tools. The Consumer Financial Protection Bureau says a borrower can also send a written information request to the servicer for the owner's name and contact information. Mortgage electronic registration systems can sometimes help identify servicing information. The chain is complicated, but federal rules do not make ownership unknowable. The system's strength is also its central tension. Selling and securitizing mortgages gives lenders fresh funding and connects housing to deep pools of global capital. Standard rules can make a 30-year fixed mortgage easier to finance at scale, but the same process separates the borrower from the ultimate economic holders and concentrates key decisions in servicers, guarantors, standardized contracts, and regulators. The debate is not whether securitization is useful, it is how much distance between borrower and capital is too much. Return to the mortgage note. The bank that handed you the money may have sold it. A trust may hold the pooled loans. Investors may own securities backed by their cash flows. A servicer may control the monthly relationship. Fannie Mae or Freddie Mac may guarantee the credit performance and set important servicing rules, while the Federal Housing Finance Agency oversees them in conservatorship. So who controls your mortgage? No single actor controls every layer. The mortgage is a chain of ownership, servicing, guarantees, and rules. Follow the money. Find the power.